All right, so we had another interesting week in the markets. A couple main pieces of news. Number one, Nvidia earnings, which was very good, which I'll get into in a little bit. Ethereum ETFs were approved. Honestly, I don't know when they're going to be trading, but it's looking like we're going to get Ethereum ETFs, which, if we want to get right into that, I mean, that basically puts the final nail in the coffin of this idea that Bitcoin's going to get regulated, because I've said time and time again, if they're not going to regulate Ethereum, they're not going to regulate Bitcoin, because Ethereum is, I mean, in my opinion, it's a security, so I'm kind of surprised that they got ETFs through, but that kind of feeds into my main point in that Ethereum would be significantly more easy to regulate, and the fact that they're not regulating it, in my opinion, just kind of proves that we're not going to get significant regulations. Now, again, we could get more, tax increases or more regulations of the on-ramps and the off-ramps. But I guess the better way of putting it is the idea that we're going to get regulation that is going to affect the long-term price trajectory is very low. It's very low. So that's one of the big things. If we look at the markets here, the S&P was basically flat on the week. I think it was up ever so slightly, but basically flat. The NASDAQ was actually up, I think, a little over 1% on the week. So again, we remain bullish. Again, like I've said, I think my opinion of near-term bullish, medium to long-term, I think over the summer, maybe in the fall, I think we see a 5, 10, maybe even a 15 or 20% pullback. That's completely in the realm of possibility. But again, I think over the short term, I still think we're gonna, if anything, we're gonna grind higher, or we kind of just chop sideways in a range of whatever 5% up or down from here. But I still think at some point we're going to go back below 5,000 on the S&P, whether it's just a little bit below like we did a month ago or whatever that was, or if it's significantly below, I don't know. But from what I've seen, if we go down to 4,800 on the S&P, we're going to see a lot of stocks that are a good deal, in my opinion. So I would be surprised if we go down anything more than like 10, 15%, barring a something that goes seriously wrong that is completely out of the ordinary. That is certainly possible, but it's pretty unlikely. I mean, there's a chance, but it's unlikely. It is likely that we see a 5-10% pullback at some point over the next 6 months or so. So that's something definitely to keep in mind. And when that happens, I would be right ready to pile into some of these stocks. Again, just my opinion. But again, that is what I think is going to happen. I think that, again, it's going to depend largely on inflation, on the Fed, on the jobs numbers, on those kinds of things. And again, I think that I'm still in the camp of higher for longer, because I don't think inflation is getting to 2%, at least in the near term. And when you on the flip side, when you look at rate cuts throughout history, the vast majority of the time you see rate cuts, especially significant rate cuts, is because something major goes wrong in the economy. So the idea that the Fed is going to bring inflation nice and smoothly down to 2%, and on top of that, they're going to cut rates and time everything perfectly, I really doubt that. So when we see that volatility from them getting one of those two things, if not both of those things wrong, that's when it's going to be a good time to buy. Because if we get a crash that comes, I mean, it wouldn't be out of nowhere, but seemingly out of nowhere, that's when we could see a lot of good deals. So that's basically my opinion on that. As far as Nvidia goes, Nvidia released very good earnings. They didn't destroy them as much as they did last time around, but they beat them pretty good, and they were up very significantly on the week. They also announced a dividend. They're increasing their dividend pretty significantly, although their dividend is going to be 0.1%. So you're not buying it because of the dividend. They're also announced a split. They're going to do a 10-for-1 split. And again, the stock was up 12% on the week, which is crazy, especially for a company that as big as they are. I think they're up to the third largest company in the world right now. Again, the one huge problem with Nvidia is still, I mean, the numbers are phenomenal, like absolutely phenomenal. Profitability is through the roof. I mean, a return on invested capital is over 100%. That's insane. Financial health, again, current ratio of 3.5 is crazy good. Shares are going down. Revenue is just skyrocketing. And again, they're projected to grow earnings 46%. Again, the huge problem is a PE of 62, price of free cash flow of 67, a price of sales of 33. I don't know any sane person that's like, yeah, I would be buying based on those numbers. Unless, I mean, especially when it's a $2.5 trillion company. If it was a $250 million company or a $2.5 billion company, maybe they could grow into those numbers. But the amount of growth they're going to have to maintain is absolutely astronomical to maintain or to make the price you're paying worth it for this stock. But again, I still think they're going to do good, all right over the long run. I wouldn't expect them to absolutely destroy the market if you buy them at this price. So I would wait for a fairly significant pullback to buy a company like this. And the chances that it gets there anytime soon is pretty unlikely, because we're going to have to see probably a 20-30% pullback in the market, and probably even like a 30-40% pullback in Nvidia to make it worth it. I mean, you probably would have to say like maybe a 35 price to free cash flow. So you're talking a 40-50% drawdown to make it worth it. So you're talking maybe $600 a share would be roughly fair value. So I think that they're still way overpriced. But again, they are a very good company. So I mean, obviously they do deserve somewhat of a premium to the market. That the question is to what extent. But I think this is just way too expensive where they're at right now. So again, other companies here. Palo Alto Networks, another very good company that is too expensive that I do want to get, but it's just too expensive. They did beat earnings and revenue, although they lowered their guidance, which initially caused them to come down, but it looks like they actually basically closed flat on the week. Again, this is another very, very good company in my opinion, but it is too expensive, right? I mean, it's not as expensive as Nvidia, but it's still too expensive. It would have to come down another 10 to 20% to make it worth it. But again, if you do get that, I think this is a very good company. You definitely would want to. This is a company that, if you can get it for a good price, you definitely want to be buying, at least in my opinion. Eagle Materials, again, one of the better materials companies in my opinion. They're a little expensive as well, although again, not expensive compared to the market, but compared to themselves, they are definitely a little expensive where they're at right now. They did miss earnings and revenue, so again, that's a little disappointing if you own them. But again, if you're looking to buy, that is a good position or a good deal. But I still think they're a little expensive where they're at right now. But again, they are a good company, so that's why I have them on a watch list at the very least. Lowe's, again, not a company that I own or really want to own necessarily, but they're a good barometer of how the economy is going, at least to a degree. They did beat earnings and revenue, although they're down year over year, and I think they lowered guidance as well, so that caused them to fall on the week. The next one is Toll Brothers. Again, one of the home builders. They missed earnings, beat revenue. They actually raised their guidance, so I'm kind of surprised that they were down so much on the week. But again, I mean, technically they did miss earnings, so that probably is what caused it. This is a pretty good company. I mean, if you can get it for a good deal, I probably would look at picking them up. I mean, if we look at their valuations, they're actually if anything, they're probably a tad expensive where they're at right now. But I mean, I don't think they're crazy expensive by any means. So definitely another one to keep on the watch list. ADI, Analog Devices. I do have a very small position in this company, extremely small. I wish I would have bought more, because I bought it at I think 170, 180, but again, what can you do? They did miss earnings, beat revenue. They raised their guidance, which again they're up quite a bit on the week. Again, this is a very good company. If you can get it for a discount, I think you definitely buy. But they're definitely pretty overvalued where they're at right now. You'd probably have to have them come down 15-20% before I would start buying. And I mean, they're only projected to grow earnings 2.8% next year from here. So definitely would not be buying them based on their current valuations. You'd have to see a pretty good size pullback to make it worth it. PLAB, again, another company I do have a small position in. They're kind of a smaller cap company in the semiconductor industry. They did miss earnings and revenue, which obviously hence why they're down on the week. Although I think they're a solid company, right? So I'm not necessarily overly concerned. I mean, if you look at their valuations, they're actually pretty cheap. I mean, especially for a semiconductor company, they're very cheap. And I mean, they're still growing fairly nicely. I mean, if we look at their growth here, I mean, their revenue, they've basically doubled over the last decade. They've grown it every year, going back about 7 years. If we look at their earnings per share, again, that's gone up pretty significantly. They're over $2 last year. 10 years ago, they were, 29 cents. So again, they've grown very nicely there. So I still like this company. I'm not overly concerned as far as the long run goes. And again, they're not expensive at all. And I mean, they got fairly good profitability. I mean, operating margin of 27%, net margin of 15%. Like, those are good numbers. So I like this company. I think that they're they're definitely more of a higher risk, higher reward, but I still think that is worth it in my opinion. TJX, again, this is a company I do have on a watch list. Definitely a popular name out there. They did beat earnings and revenue. They raised their guidance. And again, they're kind of in the retail space. And again, historically, they've done very, very well, like extremely well. They beat the S&P by a decent margin. Again, especially for a quote-unquote boring retail business to beat the S&P, that's pretty good. So the last one, Williams-Sonoma, again, another one I have on a watch list I would buy if it got cheap enough. Again, they did beat earnings and revenue. Again, another company in that retail industry. They were actually down a little bit on the week, so they must have lowered guidance or something else happened there. And I mean, they're growing their dividend. I mean, look at how much they beat the S&P. They're up 500% in the last decade. So, although most of that's come within the last year or two, so that's kind of weird. But again, they're raising their dividend very, very fast over the past. I mean, the past 3 years they've raised it 24% a year, so they basically doubled their dividend in the last 3 years. And I mean, their payout ratio is still 30%, so they're going to be able to keep growing that. So anyway, that is this week. Next week, I probably won't really be talking about earnings because there is a few companies, but not enough to make it worth talking about. So we are out of earnings season. Give it about 6 weeks or so. Probably, I think the second week of July, the banks will start releasing again their earnings from this quarter. So it's going to be interesting to see. But again, like I said, near term, I think the next big catalyst will be that next CPI report. That'll be, I think it's going to be the middle of June. So we'll see how that goes. But until then, I think we're going to trade sideways over the next month or so. And then I think once we hit that next earnings season, the market will kind of decide, hey, do we want to go up? Do we want to go down? Depending on how good earnings was. And I think we'll go from there. But I do think we're still going to see that pullback over the next 4, 5, 6 months. We're going to see that 5, 10, 15% pullback, and that could provide a very good opportunity to buy. But basically, long story short, near term still slightly bullish. Medium to long term, I think we're going to see that pullback. But again, over the super long run, I think we're still going to be fine. So anyway, that is what I wanted to talk about today. If you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.